Carl, thanks so much for joining us. Let me ask you, does it come as a surprise to you that Treasuries are actually rallying in the face of the news that the U.S. long-term debt rating was downgraded on Friday?
No, it's not a surprise at all. I mean, I think in the Treasury market, investors were prepared for this news. They've been expecting it for some time. There's only a question of when exactly S&P would pull the trigger. And it doesn't convey new information about the Treasury market. Remember, S&P is using the same CBO baselines everybody else is. So there's really no new information here. S&P's made a determination. Everybody sort of takes that with a grain of salt. And in a risk-off environment, there's still nowhere else to go in dollar assets than the Treasury market.
Hey, Carl, it's Adam Johnson here. What are you telling your clients to do this morning?
Yeah, we've been advocating buying Treasuries. We recommended that again on Friday, both before and after the release. We're still targeting lower yields in the market. I think that the overarching theme here is that we have very low growth in the U.S., less than 1% in the first half. We seem to be slowing down in the second half. And what the S&P downgrade tells us, again, which, again, we already sort of knew this, is that the scope for fiscal policy to come to the rescue is much more limited in this world. And the G10 statement last night talked a lot about fiscal sustainability, but it didn't have any mention of stimulus and growth like you would have seen back in, say, a 2008 G10 statement.
Carl, there's a $72 billion of Treasuries going to be auctioned off this week. Tell us how the S&P downgrade, today's market reaction, what does that mean for the $72 billion that's going to be auctioned off this week?
I don't think the downgrade really matters. The clients we talk to are not really influenced either way by what S&P's done. The big central bank buyers are still going to be there, for example. The big real money accounts in the U.S. are still going to be there. So I think the auction is going to be more about the typical supply and demand fundamentals. The fact we've rallied so much is something of a negative for the auction, but the overarching backdrop of weak growth is positive. So in general, I think the auctions will go okay. The curve might steepen a little bit going into the long end supply, but I don't think we'll see any sort of buyer strike by any means here.
Hey, Carl, Fannie, Freddie downgraded just moments ago. Who's next? Does it concern you, and how do you treat that?
Yeah, there's going to be a number of downgrades. Obviously, anything that's backed by the government's explicit or implicit guarantee. So we see Fannie and Freddie. We're going to see municipal bonds that have some wraps or debenture supported by the U.S. government downgraded over the coming days. All of this is to be expected. Again, I think like the sovereign downgrade itself, it's not surprising. The markets can handle it. Mortgages were widening a couple weeks ago, partly on these concerns. But we don't think there'll be much in the way of forced selling on the back of this. I think what's more important is really what S&P does going forward with other sovereigns, especially the UK and France, where they're AAA rated but with higher debt levels than the US. Now, on the conference call today, S&P said that they've seen these countries take more concrete fiscal steps than we have. So even if they're in a worse starting position, they're doing more in the form of austerity now. So if S&P sticks with that, maybe those countries will slide by.
Carl, we have about 30 seconds here, but I do want to ask you, I know your 10-year forecast, your 10-year yield forecast for end of year is 2.35%.
Yes.
What pushes yields on the Treasury curve higher at this point? Is it events overseas in Europe?
To go higher, I mean, most of the, in Europe, we'd have to see that this ECB buying program in Italy and Spain is for real. Today we've seen a good rally in both of those sovereigns. But we don't have a good sense of the size the ECB is contemplating buying. If we do see them in there every day for size, it could get us back to risk on.
We got to leave it there.